In this video, let's go over some of the homework problems for chapter number 6, especially where it doesn't have the hint video links here off to the left side of the problem. Keeping in mind that the hints may be showing old tax rates. The old tax rates were usually 34 or 35 of the high range of the marginal rates. But after the Tax Cut and Job Act, the flat tax rate, there's only one income tax rate for corporations, is now 21%. And this is what you need to use for our current problems. Okay, so we have problem number 3. Problem 1 and 2 probably have the video hints that you can utilize, yeah? Or problem 1 is very similar to problem 2. And here in problem 3, Grand Corporation reported pre-tax book income of $600,000. So this is the net income before any income tax expense being reported on the company's, the corporation's income statement. We're told that tax depreciation exceeded book depreciation by $400,000. So when you compare the income statement and the tax return for this one corporation, there's $400,000 more depreciation on the tax return. So that results in less net income or taxable income and less tax on the tax return. And in addition, the company received $300,000 of tax-exempt municipal bond interest. So that's income on the income statement and not taxable income on the tax return. And this would be what they call a permanent difference versus the depreciation will turn around in future years when the book depreciation will be bigger than the accelerated on the tax return. The company's prior year return showed taxable income of $50,000. For this situation, this would be an irrelevant fact. In prior years, prior to the Tax Cut and Job Act, if a corporation, if a taxpayer had a business loss, what we call a net operating loss, they would be able to carry that loss back to a previous year to offset income in that previous year, releasing tax refunds that would be reported as a benefit in the current period. But we don't do that. We're going to carry forward any loss to a future year. So again, here's our starting point, $600,000 of net income on the income statement. And we're going to make it smaller by $400,000 because we have more depreciation on the tax return. Or we can make it even smaller because we can have tax-free income from that municipal bond interest, leaving us with a loss of $100,000. Okay, and on the tax return, we call this a net operating loss, an NOL. And NOLs can now be only carried forward to future years to offset income in those future years, reducing the taxes in those future years. And the tax that we're assuming that will be saved is the same rate that we're using now, which is 21%. The so-called enacted tax rate. So the benefit that we're going to be reporting this year, in the year that we have this loss, that's creating the benefit, creating the current benefit, is in the amount of $21,000. Okay, even though it's a loss, nobody wants losses, but for tax purposes, it's good. It's going to save you taxes. Yeah. And not create an expense, which is the other option in the drop-down list for problem 3. Let's take a look at problem number 4. We have Shaw Corporation reported pre-book income of $1 million. Included in that computation were favorable temporary differences of 200,000. Favorable means you're going to pay less taxes because you have 200,000 more income, or less less income or more deductions. And unfavorable temporary differences, just the opposite, causing you to pay more taxes right now. And both of those amounts, the 200,000 and the 50,000, are temporary. They'll reverse themselves in a future year or years. But this last difference, which is also favorable, saving you taxes, is permanent. Permanent meaning it doesn't reverse itself. It only affects this year. Saving you taxes is favorable on a $100,000 amount. Again, the amounts described here are not taxes. They're either income or expenses. The tax effect is whatever these amounts are times the tax rate of 21%. Okay, the question: compute the company's deferred income tax expense or benefit. When you talk about deferred, you're talking about temporary, not permanent differences. So we have that 200,000 favorable temporary difference. And the way I kind of remember it is that it's favorable because you're postponing the payment of the tax to a future year, and that's creating a liability. And of course, we know liabilities are created, made bigger with credits. And at the same time, something must be debited. Debit. And that debit is the income tax expense. You're reporting the expense now on the income statement, but you're going to pay it later on in a future year when this 200,000 turns around, when the book depreciation is bigger than the tax depreciation, or whatever that favorable difference is caused by. And the other one was a 50,000 unfavorable difference. And I think as unfavorable means you got to pay the taxes now. You're prepaying the tax. Prepayments are assets that you're going to use up now. Debiting asset. And the benefit of that asset will be utilized in a future year. Yeah. So they call this a deferred benefit. It's something like a revenue. Not quite, could offset an expense account, which we'll see maybe in another problem. In fact, maybe in this problem right here, because we're offsetting the two to get this net. The larger is favorable, and I'm going to multiply this by 21% to get the tax effect of 31,500. This is what I'm saving right now because of these two temporary differences, and it's favorable, causing me to have a liability that I'll pay off later on, tax liability, but I gotta report the expense now, even though I'm deferring the liability. I gotta report the expense now, even though I'm deferring the liability, in the amount of 31,500. Okay, so there's your answer for problem number 4. Let's take a look at problem number 5. Harrison. There's a hint link, but let's go through this anyway. Harrison Corporation reported pre-tax book income of 600,000. Tax depreciation exceeded book depreciation of 400,000, so that's a favorable temporary difference. The company received 300,000 of tax-exempt municipal bond interest, so that's also a favorable permanent difference, not temporary. The company's prior year tax return, again, that's irrelevant, yeah, since we all don't carry back any amounts to a prior year, always carry forward losses, NOL losses, maybe even charitable contributions that are unused to a future year. So the question is, compute the company's deferred income tax expense or benefit. Okay, watch out now. It's deferred. What are you postponing versus what is current? And if you owe more and paying it off later on, that would be an expense. If you are paying more now and will use that as a prepayment to offset the tax in the future year, that's a benefit. So let's look at the amounts again. We have 600,000 is our starting point, the book income, pre-tax book income, and we're making this smaller on the tax return because we have more deductions or less income. So that's favorable, it's temporary, and it's causing us to record an expense and a liability, deferred liability, deferred expense. They call it deferred expense, but you're reporting it as part of your income tax expense. Yeah, debit, credit. And the other change was also favorable, 300,000 municipal bond interest, favorable, but permanent. So there is no effect on any deferred tax. You get the benefit right now. You pay no tax on this 300,000. So looks like we have a loss again, so-called NOL, that we don't carry back. So again, this previous year's income is irrelevant. We carry it forward. Now, what are the things that we're going to be utilizing in the future years that's listed here? Well, again, this 400,000 is going to turn around. So we got to take into account some type of deferred tax on that. Likewise, the 100,000 loss, we're carrying it forward. It's going to turn around. In fact, it's going to save us taxes. So I'm going to put that as a positive. This one is going to cause us to pay more taxes, right? Again, these amounts are not the taxes. This is the asset or the benefit that's going to be saving us or causing us to have more taxes. So the net amount here is 300,000 more we have to pay in a future year. Now this is not the amount we pay, it's the 21% of this, or $63,000 of deferred tax liability and recording the expense right now. Yeah, this one right here. Yeah, deferred income tax expense in the amount of 63,000. You're looking at what's temporary, or this loss being carried forward, these two amounts, and nothing else for the deferred. And there is no current income tax expense because there is no tax expense on a loss of that 100,000. It's only a benefit being carried forward to a future year. Let's take a look at number 6. And Corporation reported pre-tax book income of $1 million. Included in the computations were favorable temporary differences of 200,000, unfavorable temporary differences of 50, and favorable temporary differences of permanent differences of 100,000. Compute the company's book equivalent of taxable income. Well, I know how to compute taxable income. It would be this minus this plus this and minus this. That would be taxable income. But we're asked to figure out book equivalent taxable income. Okay, so what we do is we ignore the temporary differences. So we start off with that 100,000, 1 million again, Ignore the temporary 200,000. Ignore the temporary 50,000. But take into account the 100,000 tax-free income. So for book purposes, we're going to tax right now, this year, 900,000 at a 21% rate to give us a tax of, is that right? 189,000. Anyway, the answers are right here. The book equivalent taxable income, that's this amount here. The tax on that book equivalent taxable income, that's this amount here. What we're not showing is the tax effect of the temporary differences, the 200,000 and the 50. And if you combine those two things and you multiply by 21%, that would be not the current tax, but the deferred tax expense, which we're not asked to do. Maybe we'll see that in another problem. Let's look at number 8. We're skipping number 7. Number 8. And even though it has a hint link here, let's go through it anyway. We have Saginaw completed its first year of operations with a pre-tax loss of $500,000. The tax return showed a net operating loss of $600,000, which the company will carry forward. Of course, you cannot carry back. There's even no year prior to this first year. The $100,000 book to tax difference results in an excess tax depreciation over the book depreciation. And that's the common situation we've seen most times in the examples here in Chapter 6. But always remember, it's going to reverse itself in a future year. We've never seen examples, though, of that reversal. Management has determined that it should record a valuation allowance equal to the net deferred tax asset. In other words, we're going to wipe out that asset to come out to a zero value. There is no current expense. That's the zero here. And we've got to prepare journal entries. So in A, the first journal entry is to prepare the deferred tax consequences of the net operating loss. So again, our loss is this loss on the tax return. So 600,000 times 21% gives us 126,000 debit, 126,000 credit. And because this loss is carried forward and going to offset income in a future year, it's an asset. Here they call it deferred tax asset, like any asset increased with debits. The credit is kind of a strange account called Deferred Tax Benefit, and it's almost like an income account. Or if you did have a tax expense account, it would reduce the tax expense, which we don't have. Okay, so here's your journal entry for this first part A, recording the effect on the net operating loss. Let's look at part B. Prepare the journal entry to record the deferred tax consequences of the depreciation. So we have, let's see, the amount was 100,000 of excess tax over book depreciation. And right now, that's saving us 21% in taxes. So 21,000 debit, 21,000 credit. Remember, you're going to pay off this tax in a future year, but you're saving it now, but you're going to pay it off in a future year. So again, the way I remember it is you're postponing the tax, you're deferring tax liability, and like any liability, you increase with a credit. The offsetting debit is you're going to record a an income, a deferred tax expense now on the income statement. Even though there is a loss on the income statement, you're going to record an expense now because you're going to pay off more taxes in the future by accelerating the taxes on the depreciation on the tax return. Again, postponing it with a liability. Okay, so that's the second entry. Let's try the next step. Part C. Prepare the journal entry to record the deferred tax consequence on the valuation allowance. Again, what we're told to do is record a valuation allowance equal to the asset we have. So the asset we have is that deferred tax asset. So let's draw a T account. Remember debit, credit? So back here on the first entry, we debited that account $126,000, and we credited not the asset but the liability account here in the second entry. But for temporary differences, what we do is we kind of combine both to get the overall effect. So I'm going to put that 21 credit into this deferred tax asset account to come out to a net 105 asset. Again, the analogy or the comparable type of accounts we had mentioned before is accounts receivable, and you cannot utilize or collect all of the account receivable, so we reduce it down by subtracting out a contra account called allowance for doubtful accounts to get the net amount that you're going to collect, the net realizable value. So here is the amount of asset we have, but we're told we're probably not going to be able to utilize it. I guess management is thinking that maybe we're going to continue to have losses, and if you don't have income in future years, you cannot utilize that net operating loss. So this deferred tax asset will be wasted. So we're going to set up right next door to that asset, not an allowance for doubtful accounts, but a valuation allowance account. That's the name of the account. And a contra asset, we increase it with a credit. The offsetting debit at the same time is going to go to the deferred. Remember this account we saw previously, deferred tax benefit account. So if you had a credit before, that was revenue. This is offsetting that credit, offsetting that revenue. Okay, so debit, deferred tax benefit, credit, valuation account. So that's the answer to part C. Let's move on to the last set of problems. This is the last three, where we have Randolph Company reported pre-tax net income from continuing operations of $800,000 and taxable income of $500,000. The book tax difference of $300 was due to $200 favorable temporary differences related to depreciation, like we've seen previously, an unfavorable temporary difference of $80, this time due to an increase in the reserve for bad debts. So you remember, for tax purposes, you cannot use this reserve or allowance method. You have to use a direct write-off method. So 80,000 more net taxable income on the tax return compared to the income statement. And then 180,000 favorable permanent difference because we receive life insurance. Okay, so question A. compute Randolph Company's current income tax expense. So that starts off with this pre-tax income of $800,000, and we increase or decrease it by the well, let's break it down here. 200,000 decrease for the additional depreciation, and then 80,000 more because we cannot use the allowance method to write off bad debts, and a one-time permanent difference of not taxing the life insurance. So that should come out to our taxable income of $500,000. We multiply this by our new 21% flat tax rate to get a tax of $105,000. So this is your current income tax expense. This is the amount showing up on the tax return, not taking into account any of the temporary differences that will reverse itself to cause a deferred income tax expense, which you combine together with the current to get a total or the income tax provision amount. I think that's probably the next part 2 or part B. Yeah, we're asked for the deferred income tax, either expense, making the expense bigger with the current income tax expense, or a deferred income tax benefit combined with the current income tax expense, making the overall expense smaller. In our case, again, we're looking at the two deferred temporary items, yeah, the 200,000. Let's put that down. 200,000 favorable, and the 80,000 unfavorable, positive here, to get a net reduction of our taxable income by 120. Again, this is going to be taxed at 21%, giving us a temporary tax savings of $25,200. In other words, you're not paying this now, you're going to pay it later on. And again, the way I remember it, this is deferring the liability credit, but at the same time you got to debit something, and that thing you're debiting is an expense, a deferred income tax expense, okay, in the amount of $25,200. So last part, C, is to calculate out the effective rate, which is equal to the total tax, both current and deferred, divided by the total net income, this amount on your income statement. So if you get the two previous answers, that was the current income tax expense of 105 plus the deferred income tax expense of 25,200. You get the total tax provision, income tax provision or income tax expense of 130,200. Again, this is divided up into two parts: the amount that you're paying now, that's showing up on the income tax return, and the amount you have to pay later on for stuff that's temporary this year that will turn around in future years. Okay, so that's the income tax expense. Now we divide that by the total net income, or here operating income on the income statement, of 800,000. And your answer is going to come out to some kind of decimal, yeah, 0.16275. In percent, that's 16.275%. But here in the red instructions, we're told to answer to two decimal places. Keeping in mind your answer is percent. So here's what we're looking at. Rounded to the nearest 2, yeah? And we know that 5 and up we round to the next digit. So 16.28% should be our effective tax rate. Okay, that's it for reviewing homework problems here at Chapter 6, one of the hotter chapters of the semester. Okay, I'll talk to you later.